What happens when corporate power grows unchecked? When monopolies are allowed to dominate markets? It's a chilling question. Picture the behemoths of our time, the Googles, the Amazons, the Apples. They wield an influence that is staggering, yet not unprecedented. There is a shadow in history that looms large over this discussion, a tale that echoes through the centuries, warning us of the perils of unchecked corporate power. To understand, let's turn back the clock to 18th century France, to the rise and fall of the Mississippi Company. In 1717, the Mississippi Company was formed by Scottish economist John Law. A seemingly harmless venture, its impact was far from benign. As we delve into the 18th century, we meet John Law, a man of notable charm and undeniable wit. His brainchild, the Mississippi Company, was established with a simple yet ambitious goal: to control and monopolize French colonial trade in the New World. The company saw an unprecedented level of success in its early years. It was a golden goose, laying eggs of prosperity for those who dared to invest. This success, however, was not solely due to the company's commercial ventures. The real secret lay in John Law's ingenious financial system. It was a system that allowed the company to issue shares against its future profits. This novel approach to finance was a game-changer, sparking an investment frenzy like none other. As word spread about the company's monopoly and the potential for immense profits, speculators flocked in droves. The desire for quick riches created a speculative bubble, inflating the value of the company's shares far beyond their true worth. The Mississippi Company became an obsession, a dream of untold wealth. But dreams can be deceiving. The promise of unimaginable riches was too alluring to ignore, and the frenzy of speculation only pushed the company's shares higher and higher. By 1719, the company's shares had soared to heights unimaginable, driven by rampant speculation and the promise of untold riches. But what goes up must come down, and the Mississippi Company was no exception. Like Icarus soaring too close to the sun, the Mississippi Company had ascended rapidly, fueled by speculation and promises of untold riches. But as we all know, Icarus fell, and so too did the Mississippi Company. The company's shares had been wildly overvalued, reaching astronomical heights that defied reason and reality. This overvaluation was the first crack in the facade, the initial sign that all was not as it seemed. The shares were backed by little more than optimistic projections and grandiose promises, lacking the tangible assets required to support their inflated worth. Then came the panic. Investors, realizing the precarious position they were in, started to sell their shares en masse. This run on the company's shares was the final blow, the coup de grace, if you will. It was a domino effect, a snowball rolling down a hill, gaining momentum and size with each passing moment. The once mighty Mississippi Company was brought to its knees, its shares worth little more than the paper they were printed on. The company's fall was swift and brutal, mirroring its meteoric rise. The bubble that had been so carefully and meticulously inflated was now deflated, leaving nothing but air in its wake. By 1720, the Mississippi bubble had burst, leaving in its wake economic devastation and a nation in financial ruin. The rise and fall of the Mississippi Company serves as a stark reminder of the dangers of unchecked corporate power. This historic event is a testament to the destructive potential of monopolies and speculative bubbles. The first key point to remember is the importance of regulatory checks and balances. The Mississippi Company's rapid ascent was facilitated by a lack of control and oversight, which allowed the company to expand at an unsustainable pace. This highlights the necessity for robust regulatory systems to prevent corporations from gaining excessive power and to safeguard the stability of the economy. Secondly, the Mississippi Company bubble underscores the dangers of speculation. The company's shares were traded at inflated prices, fueled by unrealistic expectations and mass hysteria. When the bubble burst, it led to a severe economic crash, demonstrating the perilous nature of speculative bubbles and the need for prudent investment practices. Lastly, this event underscores the importance of transparency and accountability in corporate governance. The Mississippi Company's operations were shrouded in secrecy, leaving investors and the public in the dark about the company's true financial health. This lack of transparency contributed to the bubble and its subsequent burst, underlining the need for openness and honesty in business operations. As we navigate our modern economy, let the Mississippi Company serve as a warning. Unchecked corporate power can lead to disaster. It's a lesson we mustn't forget.